The taxes are coming. The taxes are coming. As we know, the federal debt has more than doubled in the last 10 years, and economists expect it will continue on this fast upward trend over the next few decades. The wealth gap is getting larger each year. For all intent and purposes, the House, the Senate, and the presidency are controlled by Democrats. We've never seen such a deluge of tax laws being introduced by Congress, impacting everything from income taxes to inheritance taxes. When I entered the life insurance business, the amount you could pass tax-free was $120,000, and the top bracket was 60%. Today, roughly $12 million is exempt from estate and gift taxes, with a top bracket of 40%. This amount will be cut approximately in half by the end of 2025, unless Congress takes actions to extend it, which they are very unlikely to do. In fact, as we've seen, they are more likely to lower it before then and increase the top brackets. In addition, tools and techniques that we've used for decades to help our clients optimize their legacy to their family, their community, are all being challenged. And this can lead to planning paralysis. So what makes our clients and your clients reluctant to take action? Based on our experience, it's often due to lack of clarity, confidence, and coordination. They often lack clarity of what their options are, they don't want to give up control, and they don't really fully understand what's likely to happen if they don't utilize the current exemptions. And finally, they lack confidence in planning and implementation around these proposed tax law changes. They need your help to help them coordinate with them and their other advisors. What if they could create a trust for the benefit of their spouse and heirs that would, number one, incur no gift tax on amounts just over $12 million, give that spouse a lifetime interest in the income and principal, limited to his or her health, education, maintenance, or support under the HEMS provisions, allow the beneficiary spouse to be a trustee of the trust, tax income to the trust back to the grantor spouse, but taxes paid by that grantor would not be taxable gifts to the trust. In addition, they could exclude the total value of the assets in the trust of either spouse upon their deaths. It would also allow the beneficiary of the trust to do the same thing for the benefit of the grantor of the first trust. A Spousal Lifetime Access Trust, also known as a SLAT, may do all that. SLATs are a powerful estate planning tool for couples who may be resistant to transfer a significant amount of assets to their heirs today, thereby losing access to those assets. Let's take a look at how SLATs work. Charlie Confidential, as grantor, creates a trust for the benefit of his wife, Crystal. He contributes up to $12 million without any tax consequences. The income is distributed as needed under a HEMS provision to Crystal, for her to use in any way she chooses, including paying for their normal living expenses. Crystal does the same for Charlie. It's critical to remember that these trusts cannot be identical due to something known as the Reciprocal trust doctrine. If trusts are identical, there could be implications from a tax standpoint. The trustee, the ultimate beneficiaries, and the creation of the trust should all be different. Obviously, legal advisors should be consulted in these and other issues. At the death of the trust income beneficiary, the remaining beneficiaries will now begin to receive the trust benefits. Typically, those are the children of Charlie and Crystal. So at that time, the income that was being distributed from the trust to help maintain their lifestyle ceases. To some, that would have a negative impact. One way to overcome that potential problem is to buy life insurance on the grantor of the trust. For example, the trust that Charlie creates for Crystal purchases a life insurance policy on his life. When his SLAT is distributed to his beneficiaries, the life insurance is payable to Crystal's SLAT. The objective would be for the life insurance to make up for the income lost from Charlie's SLAT. When both have died, the life insurance on Crystal's life will be received by the SLAT. Assuming no growth in the SLATs and that they only took out the income, the heirs would receive more than twice what they would have received without the planning and implementation by Charlie and Crystal. There's no question that taxes are coming. The question is, what will you do to help protect your clients, their children, and grandchildren by giving them clarity, confidence, and coordination in preparing for the arrival of those taxes? At C3 Financial Partners, we look forward to helping your clients gain clarity in their goals and objectives, confidence that they are making the right decisions, and coordinating with you and their other advisors.